We are getting fresh clues about the health of the economy. The Federal Reserve released details of its meeting last month where it decided to reduce bond purchases because of the improving job market. Well, tomorrow we'll get a look at the unemployment report for December. So joining us now is Lyster, host of Hot Stock Minute on Yahoo Finance, to talk a little bit about the state of things.
Yes.
So we've got the release of these Fed minutes.
Right.
Anything surprising? What have we learned?
What we really learned is what the behind the scenes was when they were making this very crucial decision to begin pulling back on their stimulus program. So what we saw was that mostly they were in favor of this. They think the economy has gained enough traction and is going to keep that traction for them to start dialing back. There were several members that were concerned that employment is not strong enough to begin dialing back. Some were concerned about pulling back at a time when inflation is still well below their target. Several members said that they wanted more of a pullback. They wanted a more dramatic reduction in the bonds that they were purchasing, but mostly they all agreed that this was the right decision. Only one person did not vote in favor of this decision, but they all stressed the importance of really telling the markets and telling the public that this is dependent on the data, on the economy. They can adjust based on the economy. And Bernanke said if it does continue on this trajectory with the kind of economic progress we're seeing, that they could be all done tapering by the end of this year.
Okay, so often when we talk about scaling back the bond buying program, it's the reaction has to do with Wall Street. How did Wall Street react? But what I want to know is, what does this mean for regular folks?
Sure. So what this means for regular folks is that if everything goes fine, if the economy really is strong enough to withstand the Fed pullback and the Fed has really managed this properly, then average people shouldn't really notice anything. It means that the economy is on its own feet now and that it's going to be fine. What people need to watch for is if something goes wrong, if the Fed mismanages this, doesn't time it quite right, gets something wrong, that could rattle markets, and many people are exposed to stocks through their 401ks and bonds. It could rattle bonds. It could impact interest rates. Already we see rates have risen a bit. The 10-year Treasury yield, which is a barometer for a lot of interest rates across the economy, is about 3%, which is high based on kind of recent history. But that's not only about the Fed tapering, that could also be about an improving economy, which you would expect rates to rise a little bit in that circumstance. So basically people at home need to know we're in a little bit of a higher rate environment, and they need to watch for how the Fed manages this, because it could drive rates up higher faster if they get it wrong. It could rattle markets if they get it wrong.
Let's talk about these December jobs numbers. What are we expecting?
So I have some good news here. Okay. We get a private payroll report on Wednesday, right before jobs Friday, and that number came in pretty strong. 238,000 private sector jobs added, which was better than the 200,000 expected. That has analysts raising their expectations for the numbers that we're going to get on Friday to about 200,000, which brings it right in line with the kind of progress we've been seeing in the labor market over the last several months. So this will be right in there if analysts have gotten this right. Nothing crazy, not a blowout month, not a bad month, just right in line with the unemployment rate staying at about 7%, which is the lowest it's been in 5 years, still much elevated compared to where it was ahead of the crisis, which was 5%.
Slow and steady is not bad, as long as it's in a positive movement. So Fed Chair Ben Bernanke, outgoing Fed Chair Ben Bernanke, is almost wrapped up his duties. He'll oversee the last meeting at the end of the month.
That's right.
Let's talk very quickly about his legacy. He's been here for a lot of bumpy things, you know?
Yes. So if everything goes well with these unprecedented measures that the Fed has undertaken, Ben Bernanke will be the hero. He oversaw all of that. He was the architect of all of that. If things go wrong down the line with unwinding all of those policies, that could get a little hairy when it comes to his legacy, and that I would dare say would impact it negatively, to say the least.
I think you're right. Lyster, host of Hot Stock Minute for Yahoo Finance. Thank you so much for joining us.
Thank you.